Hi traders, we want to talk about the risk reversion data module within the new release of version 2.5. As you can see, the risk reversion data shows you the maximum risk percentage, which is basically a percentage of account equity. The maximum risk expressed as a dollar, so I'm assuming your base currency is the dollar, so it gives you a hard figure of what you're prepared to risk on each arb trade. Lot size for each leg of the trade, so lot size A and B. The reversion potential, what this represents is the current difference between the spread value and the reversion target minus the cost of the spread. So basically, when the reversion potential is positive, it means that the arbitrage trade has got some potential to achieve profits based upon the current spread position. Channel value represents the physical value of between the upper trigger or lower trigger level and the mean. And the spread cost speaks for itself really. That's basically the cost of opening both sides of the trade, and obviously that has the lot sizing factored into it as well. So essentially, with the risk reversion data, you need to choose time frames which work. So, for example, we're looking at the Aussie dollar and the Kiwi dollar at the moment. So if we look at the 1 minute charts, we can see that the reversion potential is negative and the channel value is $3.23. Spread cost is $6. So we don't really want to be messing around with trying to arb on this time frame with these two pairs. So you've got to choose your time frames which give you the possibility of making some money. So we've just gone up to 15 minutes. The channel value is $14. Spread cost is $6. If we set our reversion target as the opposite band, you can see basically here, if we look over at the trend locking in filters, I won't go into that in too much detail, but you see the trend on basically the 15 minute, 30 minute, hourly and 4 hourly, and in fact daily is falling. So really we should be looking to try and trade off the upper trigger level and then basically set our target as the lower trigger level. So we're looking for basically a bit of a corrective spike on the synthetic trade that the arb creates, and then the system would then enter and look to exit at the lower trigger level. So for example, if we just have a look at what our our reversion to moving average is set to false, which will basically make the system use the lower trigger level as its target. So if we look at our reversion target, it's set at 0.21604. As the spread is currently underneath moving average, the system will use the opposite band as the reversion target. So in the case of this setup where we are locking to the trend, the system will be looking to go short Aussie US dollar, long Kiwi dollar when the spread actually touches the upper trigger level. And then the reversion target would switch to the opposite band, which would be 0.214, and essentially that explains how the risk reversion data is calculated and what these reversion potentials, channel values and spread costs actually mean. So when we look at trades, clearly the longer the time frame we look at, the bigger the actual channel values. So you can see here on the hourly chart, the channel value is $72. So the reversion potential, assuming we're looking to go to the other channel, i.e. set reversion to moving average to false, is $113. Moving up to the daily,
trade-off time frame parameters are disabled on this chart.
Channel value is $163. Where we are at the moment, so we're basically right at the bottom of the lower trigger. We wouldn't want to be trade this if we were looking to lock to the trend, because we can see that the trend on basically all the time frames up to the weekly chart are falling. So we'll be looking to trade this on a shorter time frame and look to basically be selling off any corrective rally in the synthetic pair. going back to our 15-minute chart, we can see that we've got a channel value of $12.87. We've got a spread cost of $6. If we look to trade the full width of the bands from the upper band to the lower band, we look at about $20 at the moment. So we need to set our risk a little bit above that. I've set the risk at 0.05% of account equity, so we're looking at $33 or so. So we'd be looking for just to capture small profits out of any corrective rally in the underlying pair which the ARBs create. That's obviously assuming that that you're using forex pairs which actually do create a synthetic trade. Obviously, if you're trading indices, CFDs, or commodities, then there won't be a synthetic pair which will be tradable directly. So that's an overview of the risk aversion data module.